Well, hello everyone. Welcome to Trading Short Verticals. I am so glad that you have decided to join us today, whether you're watching this in the archives or you're with us here live and in person. A special thank you to all of you who have brought this class to life before the cameras even started rolling by participating in the chat. So hello to Jack and Greg and AJ and Mike and Backroad Bob and Maligator. Like, some of your handles are just priceless. And Chris and Life in the Fast Lane. We also have Brent Moores with us. He's a friend and a fellow coach. He knows this strategy inside and out. So if you have any questions, don't hesitate to ask. And between Brett and I, we'll have some answers for you. So what are we going to talk about today? Well, we're going to do, we're going to look at almost 10 trades, because there's one trade that hit a target that we're out of today. So we're going to have a quick look at that. We're going to look at the 3 current positions that we have on. And then I've got 5 stocks teed up for us to look at. And we may not get to all 5, but I wanted to have a conversation around when you might trade a short vertical, or because these are all bullish examples today, a short put vertical versus a long call vertical. And what are the pros and cons of each? And I know that this is a short vertical oriented class, but this is a question that I get asked a lot. Okay, so yeah, that's what we're going to do today. So if you are not following us on X, please feel free to follow us. Consider this your invitation. At Barb Armstrong CS is my handle. Brent's is at Brent Moore CS. Just before we get onto the platform and into the thick of things, know that options carry a high level of risk and aren't suitable for all investors. We also have to apply for option trading privileges with Schwab, and not all will qualify. We use the paperMoney application on the thinkorswim desktop platform, and it's a brilliant place to learn and start figuring these things out, to make sure that you have a trading strategy, that you understand what it is, that you understand how to place a trade on the platform, that you know when you're getting in and getting out. One of the differences between a paperMoney platform and the live account is that short options will never be assigned early. And, regardless of how far they are in the money, in paperMoney, they'll never be assigned early, but that can happen in a live account. Have I seen that happen? Yes, I have. Has it happened to me? Yes, it has. Was I kind of freaked out the first time it happened? Yes, I was. And then I just okay, what do you do? And you just kind of take a deep breath. And I actually walked through, I just recorded a trade management mini session this morning on the trade we did on Microsoft last week. And so let me just bring that up. We're going to, kind of cover short verticals, do a bit of trade management, and then place some example trades. And if we come to the platform, and we're going to start with Microsoft. So Microsoft, we placed a short put vertical last Monday. We closed it out on Thursday. And, we were doing a lot of things in this class last week. So I recorded a mini session and I went through, well, what would happen if you were assigned? What might you choose to do? And then I kind of went through a little more extensive postmortem on how to calculate your loss as a percentage of what the total loss could have been. Okay, so And in this case, we got in on Monday. We thought it would stay above 425, which it did not. So we chose to close it out on Thursday. It's still not going well, but we have until the 18th. So is it possible that if we had just been patient, that it could come back up and end up closing above 425 by the 18th? That's possible. But we're just making decisions based on the information we have. Okay, so let's have a quick look at what's going on in the markets. When we look at the S&P 500, how can you look at this chart and say that it is anything other than bullish? You'd have a tough time selling me on that. It's up 21% year to date. Yesterday, this index hit a new all-time high. And today, this candle pattern is indicating that we may see a pullback for a couple of days, or, could be a trend reversal pattern. But, this is an indication that, we may be pulling back for a day or two, but up 21%. How about the NASDAQ? So we didn't hit a new all-time high yesterday. This pullback was a little deeper on the NASDAQ, that happened on all the indexes, kind of starting the middle of July. But, if you see what I see, I see this, that this index is still up 20%. Okay, this is from my mini session. We'll just erase that. It should be posted in the next day or so. So I'll post something on Twitter as soon as it's up. But I see this kind of cup and handle pattern, and then it broke above this level, came back below, which, so is it like this stacking doll kind of thing where we've now got a mini and it's back above again? But, up 21% year to date. So fairly bullish. And if you had a really good arm, you might argue within a stone's throw of the all-time high. So not too shabby. How about the Dow? The Dow 30. And this index is a little different in that it's based on the market cap. So if you have a stock that does a split like Apple did a few years ago, its influence on this index, they did a 4-for-1 split, went down by 75%. But be that as it may, we see that the Dow has been just in this kind of looping uptrend, up 12% year to date, and it has broken above this diagonal resistance line and now seems to be using that as support. So again, overall pretty bullish. How about the Russell? This is our small caps, and although we don't tend to look as often or trade as often the small caps, some of these small caps, I've got to say, like they're multi-billion-dollar companies, some of the larger of them. But we had this panic pattern kind of setting up, and it broke above this diagonal resistance line, and now it seems to be following it, kind of hugging this line, which isn't a good thing since this line is downtrending. But that seems to be holding as a support level. So we'll see where it goes, up 7.5%. So, it's in fourth place. And then what about the VIX? Well, the VIX is still high, like at 21. Like when you think about, here's our year-to-date chart, it has spent a lot more time under 15 than above 15. And not often has it gone above, well, if we change this line to 20, it hasn't been above 20 very often. So with volatility being higher, what's the advantage for us? Well, is that short verticals might bring us a little more of a credit because we're talking about selling strategies today. Okay. So let's come now and look at, when we come to our monitor tab, and I do treat this as a companion class to the Trading a Smaller Account that we gather together for on Mondays and Fridays. So today we ended up hitting our target on CrowdStrike. So if we want to come and look at this position on CrowdStrike, we bought it last Thursday. We bought it last Friday. I should say sold it. We entered this position last Friday. We sold it for $1.30. And we bought it back today for 8 cents. So that seems, maybe this was a bit of a paper money fill. If we look at our order history, we usually put in a target to exit at 80% of our max gain. So our order was triggered at, 20. We said, when this is worth 26 cents or less, please fill this. So let's go and look at the chart. Well, we see that it opened, and it may have moved up fairly quickly today, but it's had a big move. It's up 4%. And here is where our short vertical was at 275. And so we're out of that trade. And, how much did we make? Well, we made $1.22 a share, and we just did one contract. How come we only did one contract? Well, if we don't want to risk more than $500 to $550, we were risking $5 minus that $1.30. So if I take 5 minus $1.30, we were risking 370. And we ended up making $1.22, the 130 minus 8. And if our risk was 370, that was a 33% return on our risk for a trade that we were in for just under a week, from the 6th, 4th to the 10th. Okay. Yeah. So there's that one. Okay. So, small win. We started this year at 20,000, and some of these may be paper money fills, and we don't have the whole psychology of trading your real money coming into account, but a lot of our gains have been these little base hits, this 122, 150, $200. And then we've had several losing trades, like the one on Microsoft, where we ended up, it down a bit. So, okay, so that's that one. Now, what's currently in the account? Because these we do want to monitor. So on the short call vertical side, we currently have no positions. We have 3 positions still in the account, one on AMD, one on Caterpillar, and one on Meta. And, are we close to 80% on any of them? No. Now with AMD, we've given up a lot of our profit today. So if we wanted to come and have a quick look at that, I'm going to just draw this down, and we're going to come to a shorter time frame. We can see we had a double bottom where it broke out and came back to retest. We entered this trade in last week's class, and today it seems to be really pulling back. Now, we could go and see if there's some kind of news on AMD, but we might just say, well, you know what? There are other things pulling back today. Maybe we just give it another day or two. Now, I'm going to be out of the office tomorrow because I'm flying to Santa Clara for that event. Somebody asked me if they could still register. The registration is closed. If you live in the area and you want to drive there, my guess is that we would find you a seat, but I certainly wouldn't get on a plane. But anyway, that's the scoop on that. That Santa Clara Market Drive event is Saturday. If you do come, please come on up and introduce yourself. I would be thrilled to meet you. We can take a selfie somewhere, and I'll post it on Twitter. So with AMD, we could close this out and say, or we could say, hey, this is a pretty volatile stock. We see lots of big red candles and big white candles, and maybe we just, give it a minute. So we'll look at that one again on Monday. Tomorrow, Kevin will be doing the class. Oh yeah, Navigator, if you come, you'll get breakfast, you'll get lunch. They do a really nice reception at the end of the day. Like it's a first class event, these events. Yeah, and we will find you a seat. Okay, so that's that. So those are those 3 positions that are currently on. So let's have a look at some new opportunities. And yeah. So with Home Depot, I think we have a long call vertical. I don't know if we're still in that trade or not. But yesterday, this, hit a new high. I don't know if it's a new all-time high. We could come out and look at the last 5 years. It's close to a 5-year high. Not quite there, but, it's been doing not too badly. And so if we look at this and say, it was consolidating, it did break out, and, yesterday it pulled back today. But today's candle, when we look at this, it's like it's come down to the 10-day moving average, which has been acting as somewhat of a support level. And we have this candle of indecision. And it opened lower, and it's currently trading higher, although still lower than yesterday's low. It's at 410. Could we come and maybe even sell the 400? Now, we've got earnings coming up. When is earnings? Earnings is November 12th. So could we come to the trade tab, say, okay, what if we looked at November 8th? and we said, okay, November 8th, does this meet our trading plan requirements? Does it trade more than 1 million shares a day? Yes. Are these options, even on the weeklies, do they trade at least 20 times the number of contracts we'd be interested in? Yes. When we look at this 400 strike, it's saying the probability of it being in the money is about 35%, but that means you've got a 65% probability of it being out of the money. We have a 60-cent spread here, which is wider than we like, but it's about 10%, so that would meet our requirements. So then the next question is, would there be enough juice for it to be worth the squeeze? And if we get paid $1.37, then how much are we risking? And I had brought this up here, this news, a lot of companies seem to be raising their price targets. Like it's currently at 410. Baird raised the price target to 440 from 390. Someone else raised their price on this. This was Loop Capital, upgraded their price from 360 to 460. And so at least some analysts are fairly bullish. Guggenheim adjusted their price target to 450 from 390. So bullish sentiment. And so if we look at this and say, okay, $1.35, and then if we bring up our calculator, we say, okay, what are we risking? Well, if we make $1.35 and we're risking $5 minus that, that's $3.65. That's a 37% return for a trade we might be in for up to 29 days. So if we're cool with that, we'd say, okay, how many contracts would we do? We'd only do one because we don't want to risk $700 or over $700. So single order, first trigger sequence, we're going to right click, create an opposite order, and say, okay, 27. If this, that's about 80% of that $1.35. When it gets to 27 cents, we'd like to buy it back. And we're going to put that in our short put vertical bucket. Okay, so there's the first one, and this is Home Depot. Now, could we look at a long call vertical? And some might consider this to be a more aggressive entry because it's pulled back today. Now, what's the advantage of entering this today? Well, the advantage of entering this today is that if it does bounce tomorrow, then we got a higher premium than we would have had we waited, at the strikes that we're discussing. And so some might say, well, I'm going to wait if I wanted to do a long call vertical. What's the advantage of the long call vertical? Well, the risk reward ratio tends to be more attractive. So if we were looking at, I don't know if we could do 405 and 410, we just look at these same expiration dates. Here we're risking $3 for the opportunity to make two. So we're risking, $2.83 for the chance to make $2.17. Now, if we were more bullish on this, because it's at 409.91, it actually doesn't have to move that much. So if we went from, say, 410 to 415, we're risking 268. It's close to a 1-to-1, not quite, but we're risking 268 for the opportunity to make 232. But in order for us to achieve that, it has to go through both strikes. It's a little more directional. And then it has to stay above those strikes, at least long enough for us to get whatever, return that we want out of it. So we may wait and look at that again on Monday. Okay, so that's Home Depot. How about CEG? So when we look at this, we had done a long vertical on this and we ended up out of it. I'm going to do another mini session on that just for those of you who like the mini sessions. And we're going to use this as part of a conversation around how might we have reacted if this was assigned early. That one, and there was another one that we got out of the same day. It was Meta. So that's the next mini session that you'll see hitting the press. But it came up, and then it's come back down to a support level and is bouncing today. So we had done a long call vertical on this stock at 250 and 260. Could we do a short put vertical? It's at 264.67, so it's trading above that with the expectation that this might hold. And, if we, again, come and look at price targets, they've raised the price target on this, Guggenheim did, to 328 from 242. RBC raised their price target. Now, this kind of cracks me up. They raised the price target to 272, Guggenheim to 328. Like their prices kind of are all over the place. Wolf raised the price target to 285 from 273. But when we are kind of looking at things like here, RBC raised the price target to 272 from 214. But the general consensus is that people are raising price targets, even though there's quite a variety, in what they believe that target to be. And they could all be wrong, but they do spend a lot of time looking at this company if they're, giving a vote on what they think will be happening with it. So could we come out here and do a short call vertical with the same strikes? And earnings is November 11th. So if we come to the trade tab and we say, okay, earnings is November 11th, but we don't have very much volume here. If we want more liquidity, we've got hundreds of contracts when we come to November 15th, but earnings is the 11th. And so we could do the 15th, which gives us a lot more volume on the contracts. That, we have enough volume here. Well, not at 270. We only have 8 contracts, and our guideline is we want to have at least 20. And we've got a 60-cent bid-ask spread. Well, on a $16 option, that's acceptable. Well, actually, we wanted this to be 260 and 250, didn't we? Yeah, 260, 250, pardon me. So 28 and 11, that's a little skinny. If we come up here and do 260, we've got 421 and over 2,000 and a bit tighter bid-ask spread. So let's look at this, and then we'll put a note that earnings is coming up and that we want to, no matter what, we'll be out before earnings. Why is that? Well, because if it gaps up, we're laughing. But if it gaps down, we could very quickly be looking at something akin to a max loss. And we don't want that. Now, what's our max loss here? If we're getting a credit of $4, our max loss on this would be $6, right? Because the difference between the strikes is $10 minus our credit. So our max loss theoretically $600, max profit $400. So this is at the top end of our range of acceptability, but for example purposes, we're going to put this one in, and then we're going to only do one, obviously, because we're risking $600. We're going to say, hey, when this is worth 80 cents, we'd like to buy it back. Good till cancel, confirm and send, note, earnings, November 11th, close out prior. And short put vertical. There we go, fire in the hole. Are we out of the trade on Nike? I believe we are. That's a question in the chat. Okay. So that is CEG. Okay, so maybe the theme for today, I should call it like when to follow your rules and when to bend your rules. And you might even say, I didn't even know we had rules. Well, we do. We created an example trading plan. And if you want to see that example trading plan, let me just see if I can pull it up quickly here. So here are our trade management mini sessions. So, this is why you want to subscribe by clicking on that button on the lower right if you haven't subscribed to the channel. This is the trade management mini sessions. And here's our example trading plan on short put verticals. So we walk through how one might create an example trading plan. And we kind of type it up as we go. And although you can make your trading plan anything you want, one of our examples is that we want to look at 20 to 40 days. One of our example are 20 to 50 days for an expiration date. That will become significant in a moment. Another example rule was that we don't want to trade this over earnings. And so we just placed a trade where the expiration date is after earnings, but we put a note in to say that no matter what, we're going to exit this prior to earnings. Now, this is also, when we come back to CEG, one of the things about looking at earnings coming up, this has come down to a support level and bouncing. So often if things move quickly like it did this time, our expiration date was November 15th, which is that 4 days after earnings, but we were only in this trade for 1, 2, 3, 4 days. So, this is where some might say, well, with the short put vertical, sometimes time decay takes a little bit longer to work its magic and help us hit our target. But if we were, so I can edit this line now. Well, I'll edit it afterwards because we're going to make this a short put vertical. And could we introduce a new long call vertical trade at, say, 260 and 270, and we're already halfway through, and then compare that to the short call vertical, which was one of the things that I wanted to do today. And so we're going to come to our trade tab and we're going to look at the same strike. So again, November 15th, only this time we're going to look at 260 and 270. So we're buying, and then we're going to compare these two strikes. So this is at 515. So again, we're risking 515 to potentially make 485. And I'm going to take that 515 times 1.5. And with a short put vertical, we want to get out when, this is our example rule, when we've got 80% of our max gain. With a long call vertical, we want to get out if we have either a 50% gain or a 50% loss. So single order, first trigger sequence, right click, opposite order, and we're going to make that 772. Good till canceled. Confirm and send. And we're only doing one of these because we're risking, $515. And we're going to compare to the short put vertical. Now, and I don't know if this will still be appropriate, but I wanted to look at Shopify. And here's another case of, maybe, might it be lucrative enough that we might consider bending our rules. Now, here, earnings is October 31st. And if we wanted to do a short vertical, and again, if you come and look here, Baird maintains an outperform, raises price target to 90. Loop Capital raised price target to 90. This was all on the 9th. And that isn't a guarantee. Citigroup raised the price target to 103. So we have something that if we were to look at this and say, well, this is up just a mere 6% year to date. But we had this consolidating pattern. It's broken out above, came back to retest. Then, let me change my drawing tool. It's broken out again above this kind of level. So could we come in and look at something around the 80 strike, which would be below this resistance level, anticipating that this might become new support? But if we have earnings on the 31st and we want to be out of it prior to that, well, could we look at November 15th? That's only 2 weeks. Oh, sorry, just a sec. October 31st. So this is going to be the 25th. That's only 2 weeks. Because, November 1st is, a little late. So could we sell, and this is a trade, typically we're saying 20 to 50 days. It's less than that. Do we have lots of volume here? It's a weekly, so we're not going to see as much volume as we are on the monthlies, which is pretty typical. We have a delta of 30, a probability of it being in the money of, 32%. What delta means is if the stock goes up by $1, the value of this option drops by 30 cents, and we're selling something that we want to go down in value. So, would there be enough in this for it to be worth the risk? Well, if we look at this, 28 cents, how much are we risking? 72. So 28 divided by 72, that's a potential 38.8 or 39% return for a trade we would be in for a maximum of 2 weeks. And so if we were bullish on this, could we place that trade? And is it a little anticipatory in that it did pull back today? Although it opened lower and has rallied throughout the day, it's still 65 cents shy of being, bullish on the day. And so if we wanted to place that, and our strike, if I edit this, would be down here, short put vertical, October 25th. Oh, and it's 80 and 79. And it's October 25th. So if we look at that and think, I think from a technical perspective, that makes sense, then you might choose to place that trade, even though it's for a shorter time frame. And so if we're risking $75 a contract, and we don't want to risk more than 500-ish, if I divide that by 75, how many contracts could we do? We could do 6. Well, 6.66. If we did 7, how much are we risking? $520 for the opportunity to make 182. We're going to come in and say, hey, when this is worth 3 cents, we would like to buy it back. Well, actually, 5 cents is 20%. Good till canceled, confirm and send. And so I'm going to put this, it's in our short put vertical, and this is a weekly expiration. We want to be aware of that. There's no guarantee that it's ever going to come down to be worth a nickel. And we are going to put a little note in here that this is a trade with a shorter than usual expiration date. Only 15 days to expiration due to earnings. So, some with earnings might say, as we did in the first trade, we realize that earnings is, going to happen prior to expiration, but we're going to manage it ahead of time. Others might say, I'm just going to look at doing a shorter term trade that avoids earnings altogether. Now, trader number 3 might say, this doesn't meet my trading requirements any which way but loose, so I'm just going to look for another opportunity and I'm not going to place the trade at all. And that's, there's nothing wrong with not meeting a trade or not placing a trade that doesn't meet your rules. And there was a coach that I loved to follow when I first came into this world of trading and attended a lot of his classes like this. And he'd say, know what your rules are, and then know when it's appropriate to change them. And so here's a case where we've looked at our rule around trading over earnings, and we've massaged some of our guidelines to try and accommodate what we think might turn out to be a profitable trade. Now, are there any guarantees? If anybody tells you something's a sure thing, run far and run fast, because there is no such thing as a sure thing. Someone is saying that spread looks a bit thin. Do you mean tight as in it's only $1 wide? Yes. Now, could we have made it wider? Yes. We could have done 80 and 78, but if we got paid 25 cents for $1 wide spread, often, well, here we get paid 46 cents for a $2 wide spread. So what's the advantage of that? Is that your commissions are going to be less. Yeah. So, but it doesn't give us double the credit. Double the credit would have been 50 cents. So it's kind of, 6 of one, half dozen of the other. Somebody's asking if you could add a stop to the trade. We can. The reason we don't tend to do that is because sometimes there's volatility when the market first opens, and you could have something that came down and then rallied dramatically, like here on this day. Something, it opened way low and then rallied dramatically through the day, and you may not have wanted to end up out of that trade. So, it's, we have decided that we're position sizing based on max loss so that we don't blow up the account if we incur the theoretical max loss. One of our rules or guidelines that we do not break is that we never let these go into expiration. We always close them out prior to expiration, so that we don't put ourselves in a position where we could end up losing more. Okay. So that was Shopify. Let's see what we've done. So we've opened a position on Shopify. We did a short put vertical with a $1 wide spread. And could we have made that a $2 wide spread? We could have, and we could have done fewer contracts. We did both a short put vertical and a long call vertical on CEG. Okay, so, and then we also opened a position on Home Depot. Now, we don't have a lot of time left, but if you wanted to do some practicing, could we look at something like NVIDIA, which, NVIDIA's got to be one of the most talked about stocks in town, year to date up 170%, was kind of consolidating here and is moving to the upside. So yes, we could. When is earnings coming? Not till the end of November. So that gives us lots of time. We just closed out a trade recently on CrowdStrike, and it's moving to the upside, and some might argue breaking out again today. So might that offer some possibilities? Yeah. And, stops aren't guaranteed to fill at any price. Neither is our target. Like, it may never hit our target. But if you wanted to do some practicing, and I'm sure there's lots of other opportunities out there, but those were a couple on my list today that we didn't quite get to. But, so in summary, what did we do? Well, we looked at, our rules and when to hold true to them, and when we may be able to do some manipulating to still be able to place a trade. And it'll be interesting to see how these pan out. So that's what I've got for you today. If you haven't hit the like button, it's a chance to not only let Brent and I know that you appreciated what we covered today, but it's also a way to move this up in the algorithm. So you could be doing a favor for someone whom you will never meet by helping them find this content. So if you'd hit the like button, that would be great. Don't forget to follow Brent and I in the land of X, formerly known as Twitter, Brent Moore, CS, and Barb Armstrong, CS. Know that on Twitter, and Brent has had the same issue. We have both had a lot of impersonators, and you should feel flattered by that, because if they're impersonating Brent and I, it's because they want to get to you and they think you are valuable. But what they're trying to do is scam you. So no coach will ever offer you a Bitcoin deal or a crypto deal. We will not offer you special private education for just a few, for which there is a fee. We're not going to ask you to follow us on Telegram. I think I have some fake account over there. I've got to go over and shut that down. We also won't offer to trade your account on your behalf and split the profits. If you give us your sign-in information, never give anyone your sign-in information. You guys all know that, right? So there is only, one original Barb and one original Brent, and know that although we're providing lots of valuable content, we're never going to reach out to you privately for anything that requires you to get your wallet out. And, when I do talk about these in-person events, I think they're fantastic. They don't cost you a dime to attend other than the gas it takes you to get there. Or, if you're coming from out of town, and I know a lot of people do, they'll get on a plane like I used to do, fly somewhere and book a hotel and attend these events, but there's no fee to attend. So guys, that's a wrap for today. Thank you so much for joining me. Up next is Long Options with Connie Hill. I hope you'll stick around for that. And I will be out tomorrow, but I will be back on Monday. So an early, have a great weekend to each and every one of you. Kevin Horner will be filling in for me tomorrow, and he always does a fabulous job. So we'll see you then. Bye for now, everyone.